U.S. inflation last month came in hotter than expected, with consumer prices rising 3.5% from a year earlier, rather than the 3.4% that was expected. That might not sound like a lot, but investors are taking it as a sign that the Federal Reserve, which wants to push inflation down to about 2%, will not be in any hurry to reduce interest rates. Here to discuss this is Tim Pagliara, the Chairman and Chief Investment Officer of CapWealth. Thank you so much for joining me today, Tim.
Good morning.
So, Tim, consumer prices last month rose more than Wall Street was expecting. What does this mean for expectations of a June rate cut from the central bankers at the Federal Reserve?
Well, the Federal Reserve's in a tough spot right now, primarily because expectations were for the rate cut in June. In fact, more rate cuts. So every month this year, investor expectations have had to be readjusted to where now, I think conventional wisdom is building that there may be only one rate cut, and that would be in the fourth quarter of this year. It's unnecessary when the economy is doing as well as it is, because we have to bring that into the equation, and inflation is trending higher, and it's going to continue to trend higher as we go through the year, I believe.
So, you don't think there will be a rate cut in July?
No, no, I am in the camp that believes that if we get a rate cut, it'll be in the fourth quarter. It'll be somewhat gratuitous to the market and the election cycle. But it's unnecessary right now because the economy's running hot. Inflation is trending in the wrong direction. And anything that we do in cutting rates is going to be counterproductive to inflation.
So, if interest rates stay higher for longer than investors were expecting, will that eventually take a bite out of economic growth?
That's not necessarily. I mean, we have done very, very well with higher interest rates than even we have now. So interest rates, I think, are a comfortable level. You have to remember that investors make better decisions, private equity, everybody makes better decisions when you're not pricing rates artificially low. And so if you look at where inflation is right now, I wouldn't expect any cuts in rates, especially when you look at the Fed maintaining a 2% target. So even if we were at 2% inflation right now, rates are about where they need to be. Maybe the short end of the curve being a little better, but I wouldn't expect anything different than what we have right now.
So, you kind of mentioned earlier the election, and that's when you think the first rate cut will happen. Do you think today's news will actually impact the presidential election in any way?
I don't know that today's news per se is impacting the election, but I think I'd lay it out this way. If the economy is this good, why does the American consumer feel this bad? And that's the issue. And part of that is explained by when you look at the consumer price index and you look at one of the big components of inflation is housing. Housing costs year over year rose 5.9%. And the consumer price index, while it's weighted 40% to housing, there's one thing it doesn't take into account, and that's interest expense. And so in addition to all of these building costs and taxes and everything, insurance, everything related to home ownership going up substantially, that first-time home buyer that 4 years ago could get a 3.5% mortgage is now getting a 7% mortgage. So their cost of occupancy has risen dramatically. And I think because of the shortage of housing, the pressure on that sector of the market, and that's where people live, no pun intended, but that's where they feel it. And I think that's one of the big disconnects. And that's a very, very difficult problem to solve because you have to increase the supply of housing before you're going to get these inflationary pressures under control.
Well, speaking of housing, have there been any initiatives to solve that problem? I mean, 7%, that's pretty high.
No, and all these initiatives take money. How do you go to Congress now and get $100 billion, for example, for housing? So the government's going to have to be creative. There are opportunities available, for example, in capitalizing, the taxpayers' investment in Fannie Mae and Freddie Mac, bringing them out of conservatorship. That's $100 billion that could go back into housing, $230 million for each of the 435 congressional districts in the United States. And it wouldn't cost the government a dime. In fact, it would improve the housing finance market by putting more capital into it. And that's the type of thing that is going to increase supply. When you start removing some of the structural barriers that exist that are keeping the housing supply, in a shortage mode.
Mhm. Well, Tim, let's go back to today's CPI news. Bond yields jumped on the CPI news. Where do you think they're going from here?
Well, I think they'll go back to where they were in the fall of this past year, so of 23. So you could see the 2-year Treasury, which is now over 4.7. I think it peaked at about 5.3. That would be a normal thing. The short-term rates are going to stay where they are, and I think you'll see the 10-year trend back up, probably at 4.7, 4.8% in the environment that we're in right now with no rate cuts.
So the dollar is up on this news and gold is falling, as you might expect. What can we look for in the coming days?
That's as far as what? As far as the price of gold, the dollar,
Oh,
I
yeah.
think,
Mhm.
we describe this as like a financial whack-a-mole, and every time that we solve one problem, we create another one. So I think a lot of what we're going to see is just going to be dependent upon how the markets continue to react. We've got a lot of global instability. This isn't just interest rates. It's the election cycle, it's global instability, it's the inflation number. So all of those things are going to have a factor. I think it will certainly dampen the environment for both stocks and bonds as we go into this election cycle.
So there's been a sharper rise in core prices at 3.8%, which reflects upward pressure from gasoline prices. Are there any other hotspots we should be looking at?
That's, that was the other one. We didn't mention it, but it's housing prices, it's fuel prices. The year over year now, fuel prices are up over 14.6%. So again, when you talk about inflation and why it's moved up from last year's 3.2 to 3.5 in the CPI, it's easy to understand. We got a tremendous amount of benefit from the relaxation of the supply chain constraints. That's what had inflation in that 8 to 10% range. So when you get that type of relief in the supply chain, but these other factors haven't changed, then that's why the number keeps trending back up, because there's nothing that is driving inflation down right now. Government spending's not, and certainly, the economy is still running hot, running very well.
So are there any sectors where inflation seems to be coming under control?
I think, there are parts of the food prices seem to be moderating, but again, inflation's moderating on a much higher level. Food prices are up let's say 25% over the last 4 years. Well, if they're only going up 2.5 to 3%, that doesn't help the family of four that has lost grounds to inflation through their purchasing power. Their purchasing power continues to erode, which again, that creates another problem, because when you look at labor contracts, these labor contracts that are up for renewal, they want to catch up with what they've lost, right? So you've got tremendous pressure. So most of the big labor contracts have 3 to 5 year, 8% average wage increases. That in itself is inflationary. 2/3 of inflation is wage and benefit costs. So if you see those moving at 8%, it's hard to get inflation down below that 3.5%, 4% number on a sustainable basis.
Well, Tim, is there anything else on your radar regarding today's CPI news that you believe should be on ours?
I would just put in perspective the inflation rate for the last 50 years has been somewhere between 3.5% and 5% on average. So we live through this. We will live through this. It will be a little bit more difficult. It is harder on the bottom 50% of society that doesn't have financial assets or real estate hard assets that will go up with inflation. And that's going to be the toughest part of this to deal with, because we have to solve the housing problem. We have to get education costs under control. And we have to do that in an environment where we minimize the impact of taxes on the American consumer. So, there are a lot of challenges going forward.
Well, thank you so much for joining me today.
Thank you.